Assalamu alaikum friends, welcome to day 12 of AFM 14 days revision crash course. And this and the next video will be on accusation. This one is going to focus more on the theory part, whereas the next one will be on your business valuation, calculations and all. And please pay more attention to this topic because from the comments and the emails that I receive worldwide from all of you, always says me the same thing that ma'am, accusation is one of the hardest topic. How do we deal with it? How do we know where do we start? Even though we know all the business valuation techniques. So for them, this is like a very important video that you must watch. So let's start with the past exam history, types of merger, organic growth versus accusation, acquiring companies, corporate and competitive aspects of merger, synergy, causes of failure, regulation of takeovers, defense against takeovers, financing of merger, and evaluating a share for share exchange. Okay, so let's start with the past exam history. If you have seen in the history, accusation is also another topic after risk management and investment appraisal, which comes. Okay, which usually comes and it can come in any question. It can come in any question. It can come in question 1 as a 50 marks question, or it can come in question number 3 as a 25 marks question. Okay, if it comes as question number 1, that shows that you have a lot of work to do there, right? They will ask you theory, they will ask you one question will be on business valuation for sure, and then the other parts maybe defense mechanism, right? Or financing merger. It could be asked on anything. Okay, as you can see here, first one topic is considerations on an accusation, discussion of the price, what is the best price for accusation, then discussion of defenses, like defense mechanisms are there, then cash versus share offer, reverse takeover, synergies, regulation. These are some important topics that you need to go through when you are going through accusation and merger. So starting with types of merger, there are 3 types of merger. Okay, all these things are purely needed if they ask you questions, theory questions. One is horizontal merger, second is vertical merger, third is conglomerate integration. Horizontal merger means when you're in the same line. For example, Toyota joining with Ford. Both are car industry, right? Both are in the same stage of production. Both are car companies, same industry. Vertical integration. In vertical integration, there are 2 types. Backward vertical integration, forward vertical integration. Backward means you are joining with your supplier. You are integrating with your supplier. Forward means you are integrating with your retailers. Understanding? Conglomerate integration means it is totally unrelated business. Okay, let's say a car industry joining with hotel industry, like that. Example, okay, accusation of Sheraton hotels by Marriott. What type of accusation is it out of the 3? Is it horizontal, vertical, or conglomerate? Horizontal, because both are in the hotel. Second is okay, that was one example. Now this is the main topic which comes for your theory. Organic versus accusation, which is better? See, there is no right and wrong answer. Organic has its own advantages, accusation has its own advantages. You have to know both. Okay? Remember, whichever method you use, one objective is maximization of shareholders' wealth. If it is through organic growth, you go for it. If it is through accusation, you go for it. Okay? Then, external growth should only be considered after organic growth has been rejected. Let's say you will not jump to accusation. No company jumps like that. You will first see, do you have a chance for to grow organically? If not, then only you will choose to accusation. Now we are going through advantages of organic growth. These are quick, easy. We can quickly go through them. It's just a list. Okay. First, it fits with your strategy. Organic means inside you are growing organically. You are using your own resources and all. Right? So it is in line with your strategy. Second, less risky also. Third, cheaper also. Fourth, no problem of integrating two cultures, right? Because it's your own culture already which you are carrying forward. Then managers does not have to learn new business and all. Unlike in acquisition, when you're acquiring another company, you have to learn their culture, their way of doing things. You understanding? It's hard to integrate two people, their culture, their system. But in organic growth, you can overcome all this. There is no issue like that. So these are the 5 advantages. Now coming to the advantages of acquisition. First, speed, which was not there in organic. Remember, organic growth takes years because you are using your own internal resources. And once it's not there, once your earnings are exhausted, you have used it entirely, you cannot grow anymore. It takes a long years. But acquisition, speed is there. Second, reduces risk of oversupply. Third, elimination of competition. When you're acquiring, what are you acquiring? Basically, your competitors only. So the more competitors you acquire, now they are into your business, less and less competitors you'll be having. Increase in market power. When many people join, powerful companies join together, they become a power. Your market power increases. You can dominate. Acquiring highly trained staff, you can take the highly trained staff from your competitors. And also quick advantage. Any market opportunities arises, you can take the quick advantage through acquisition. Now, acquiring companies needs to go through these 4 stages. Number one, first is, do you decide to expand? What is your decision? Do you want to expand? If yes, second is, you choose a criteria. You just don't expand. There are some criterias. Number one, finance, of course. Second, finance and commercial. Understood. Then look for targets in the sectors. You have to look for those targets. Who are your target company that you're targeting in that sector? And finally, compare the target with your criteria. Do they fit with the criteria? If yes, you acquire them. If not, you don't. This is how acquisition normally works. In the exam, you don't have to write all this for, by the way. I'm just making acquisition easier for you to understand. Okay. Next, cooperative, corporate and competitive aspect of merger. Okay, these are some aspects that you have to write. One example is impact on the board structure. See, when you acquire, right, it impacts your board structure because you're taking new people, some old people leaving. It impacts that board structure, and even the board might not like it, they might reject. Second, impact on the corporate governance. Corporate governance, from your SBL, you must be knowing what is corporate governance in detail. If you don't know, okay, well, you don't have to worry so much. Just know corporate governance is basically how sound your company is in terms of how your board is structured. Do you have the auditors to check your company? Are they complying with all the rules and regulations? Are they having a proper risk management to manage the risk of the company? All this is how accountable the company is. Are they filing their tax return on time? So this is the meaning of corporate governance. Okay, acquiring impacts all this, has an impact. Third, cultural differences, of course. Not every company will have your culture, so it's hard to integrate them. Then you might lose some of the key personnel of the target company. They might leave. Capital structure of the combined entity, debt equity changes. Role of regulation also. See, it's not every time you want to acquire something you can easily merge. No. Sometimes the rules will not allow. The government will stop you from doing that if they feel that you are acting against the public interest. Now coming to synergy. There are 3 types of synergy in AFM you need to know. And you might be asked question on this as a theory question. Number one, revenue synergy. Okay, revenue, cost, and financial synergy. Let's go through revenue synergy first. Revenue synergy means, in your case study, what you have to see is to identify what type of synergy it is. You have to see whether there are any economies of vertical integration. If we are vertically integrating, there should be some economies of scale. You might be driving down the cost because of that integration. Look for it. Market power. This also will give. Why? Because all these economies of vertical integration, market power, complementary resources only will increase your revenue. I know this is indirect. Easily you cannot measure the revenue, how much revenue you have incurred, but through the market power, complementary resources, economies of scale, you can measure. You can somewhat say it's revenue synergy. By the way, what is synergy first of all? Sorry, I directly went to the types of synergy before explaining you the concept what is synergy. Synergy means when two companies join, the value of the combined company is greater than the two companies operating separately. It's like 2 plus 2 is equals to 5, not 4. That plus 1 is what is known as synergy. Okay. The value of the two company separately, if you add them, the value should be greater than that. That is synergy. You understanding? Second is cost synergy. Cost synergy means your economies of scale, it will deal with the cost only and scope and elimination of inefficiency, because if inefficiency reduces through merging, cost also will fall down. Financial synergy, elimination of inefficiency again, surplus cash, right? You can take advantage of each other's cash. One company might be having surplus cash, other company might be lacking it. So through merger, you can take an advantage of it. And then risk diversification. If you are in some other industry separate to yours and you're merging with them, you can reduce your risk. Diversify. Risk is diversified. This gains may not occur and there may be diseconomies of scale. Remember, not every time a merger occurs, synergy has to be there. Synergy has to be present. No, sometimes none of the synergies might be there. Okay, especially if the market is already a very efficient, there is no any issue, no any inefficiency, then it would be very difficult for synergies to arise in that condition. Okay, so in that case, in practice, what happens is normally in real life, value of the synergy is low. Okay, and firms generally pay a premium to acquire others. You cannot say only because of synergy they are combining. No, they have to pay a premium to acquire others. Maybe because of the goodwill they have or various issues. Now, coming to the causes of failure. Why it fails? Not every synergy. Most of the time we have seen that mergers and acquisition fails. Maybe 70% fails. Only 30% survives the first 3 years. Why is it? Number one reason, over optimistic. When they were assessing economies of scale, they thought when we combine, our cost will fall down. It was an over optimistic. They were very positive. Second, they didn't investigate properly. They didn't investigate properly. Third, personal problems were there which they were not able to see properly. Before the mergers actually happened, then only they came to know the problems, personal problems. Fourth, status of the respective board of directors. Dominance of the subjective factor, such as the status of respective board of directors. Yes, it might dominate them. They might not like it. They might not act for the interest of the company after the mergers. Difficulty of valuation. Sometimes, most of the time, this has been the reason. See, valuation in real life is not easy. Even though we might have so many methods and models to value, in theory, in practical, it's not easy. Very difficult. Okay, it is always an estimate. Some subjective number is there. It's very difficult to measure that number, even though we give one value or some value. So that value also could be wrong, because based on that value only we are acquiring. What if after acquisition we came to know the value was not that much, but we paid so much to acquire that company? So the company will collapse, right? Now there are regulation on takeovers also. It's not that your wish. Today you are taking over this company, tomorrow you want to take over that company. It goes through a lengthy process because it's highly regulated. Okay, but this varies from country to country. Okay, but mainly it is about directors. In US and UK, this is known as market based. Okay, that means they are more focused on the shareholder, focusing on the protecting the rights of shareholders. European model uses a stakeholder perspective. Stakeholder means they want to protect the right of all stakeholders. This model is better in dealing with agency problem. Okay, but if you see in terms of efficiency, US UK model is more economically efficient and it's becoming more dominant also. Why? Because it's easier to focus on just one shareholder rather than group of stakeholders. Right? Now, this is a very, 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 very favorite topic of mine. Okay. And if you are given, which definitely will be given a question on accusation. Business valuation we know will definitely come. But apart from that, this also might be asked. That is defense against takeovers. Go through this very properly. Okay. This all these topics in this area are highly, it has a high chance of coming. Okay. Maximize share price. Defense means, see, managers might not be always, sometimes shareholders might not be happy. Or managers, let's say, managers of the company might not be happy with the takeover. They want to defend themselves against takeover. How do they do that? Right? Pre-offer means before the takeover offer has been given, they take this measure. Post means after the offer has been given, they take this measure, the defense mechanism, anything. Pre or post does not matter so much, but you have to know this defense mechanism. First one is you maximize the share price. It's a pre-offer. You do this before the offer. It could be a post-offer also. Clear strategy. Keep a clear strategy. It could be for both. Communication. You communicate. Right? Press contact. Mostly done post-takeover. Post-offer, sorry. White knight defense. It's a post-offer. Pac-Man. Post-offer. Crown jewels. Post-offer. What is white knight defense? What is Pac-Man and what is crown jewels? There are more also which was not included here, poison pill and all, but better to know all these terms because you have to explain this. Tell me. If you want to Google it right now, you can Google it. I'm giving you some time. You can go back, Google it, and then come and answer. Okay. So white knight means it's like you are calling your friend to save you, to rescue you. A third person coming in, a third company coming and rescuing you. If you are in a position where you will be taken over and you don't want it to happen, what do? You call someone who is friendly, okay, who acts like a friend to your company, okay, who comes and rescues you. How? They come and acquire your company, okay, okay. So they come and acquire your company. This is for only for a temporary period, so that the company which is not friendly to you, who wants to take you over, will not be able to take you over now, knowing that you are already been taken over by another company. So you tell your friend or another company whom you are close to, they act like a friend. They come and rescue you at that time. Later, when this takeover offer is cancelled or rejected and anything, they return you, they return back your shares and all, and they give you the company back to you, right? So it's just for a temporary period. It is known as white knight defense. The term is known as white knight defense. What is Pac-Man? Better explanations are there in the textbook if you want to memorize it. This is just a brief explanation, general explanation I've given. Pac-Man, what is Pac-Man? I'm not talking about the game Pac-Man, by the way. I know all of you are imagining that game we used to play in the computer, Pac-Man, earlier those days, right? What is a Pac-Man strategy? Tell me. Tell me. This is like a, if you have a threat of being taken over, what do? You do a counter offer to that company. You threat them that you are going to take them over. So they become scared, and then they will back off, right? The one who wanted to take you over in the first place will now back off, knowing that you are also in the position to take them over. You give them a counter offer that you are going to take them over. So it's like you are going to, that game Pac-Man, they come and eat all those small small dots, right? They eat and finish. It's the same. It's like a counter offer. Crown jewel, like the word jewels, okay? Most valuable thing. So jewel is like an asset. Whatever the valuable asset you have in your company, what do? You sell them off. Why? See, why were you a target? Why were you attractive in the first place? That a company wants you to take over because of the asset that you have in the company. One of the reason is asset. So if you sell that asset itself in the first place, why would that company take you over? Right? He will back off. Once he knows that those assets are not there in that company anymore, you have sold them off. Or you are planning to sell them off. So the meaning is crown jewel. You have to know all this meaning, by the way. Okay, Pac-Man, crown jewel, white knight defense. One more is there. Poison pill is there. Now, financing of merger. Another important topic. How do you finance merger? This has been asked in most of the exam that I have seen so far. Okay, you can finance a merger in three ways. Cash, share, combination of the two. That is cash and share. Okay. In principle, the issue of the share is no more expensive than cash or debt consideration. Issue of share is also expensive. Don't think it's not expensive as cash. Okay. But this affects your structure of your cash and debt. Sorry, your debt and equity. So it's not so easy. So don't think issuing share is very easy and it does not come without cost. No, it comes. And don't forget in an exam to consider the position of shareholders in both the company who is taking you over and the target company, unless stated otherwise. You have to give the position of the shareholder in both the target company and the predator company. Also, you have to consider this thing. What is it? Share price. Impact on the share price of the share or the cash or the mixed offer. EPS, earnings per share, price earning ratio, dividend cover, both before and after the proposed merger. Don't forget all this in the exam. Next, financing available for cash. Based accusations can come from this. See, when you are acquiring through cash, can come from this. One is maybe you have the retained earnings, through that you are having the cash. Second, you are taking a loan. Third, you are selling your existing asset. Fourth, you are issuing shares, that's how you are getting the cash. Or right issue, you are giving your shares to the existing shareholder. Or a mixture of the above. You are mixing one or two or three with each other. You have to know how you are getting cash. Okay, it could be out of all this, any of this. Next, or mezzanine finance. What is mezzanine finance? It means it is a mixture of debt and equity. Okay. Now, evaluating a share for share exchange. Now we are in the last part. We are done with cash offer. Cash exchange is easier. You give cash and you take the company. Share for share exchanges. Okay, this is a little difficult in terms of calculation also. Students often complain with this thing only. So value the predator company as an independent and then calculate the value of the share in that company. Okay. Repeat the procedure for the victim company what you have done for predator above. Third, calculate the value of the post combined companies post integration, after the integration. Okay, the combined company's value. This is how you do it. Value of independent, value of a predator as an independent, value of victim as an independent. Add both, add the synergy also. Synergy they will give you in the exam. Okay, what is the synergy? Then it is known as total value of combined company. Okay, now how do you calculate shares? Very important. Please hear this. Calculate the number of shares post integration. Okay, this is how you do it. Number of shares originally in the predator company, number of shares that is issued to the victim company, and total shares post integration. You add both, that is your post integration share. Now calculate the value of the share in the combined company Then only you can see how the wealth of the shareholders increased or not. Understanding? So that's it for this lecture. Next, for day 13, it is business valuation, mostly calculations. Thank you for watching, and don't forget to subscribe to my channel if you haven't subscribed, and best of luck for your AFM exam.